Hi everyone, this is Paul Lange with another topic in a series of free online videos you can access at disciplinedtradingstrategies.com on the free stuff page. This topic is about the tradability of stocks and understanding order entry. Ideally, this video should be watched after watching the video called Controlling Slippage. You should find that one right next to this video, whether you're looking at it on my website or on YouTube. If you've been watching these, I'm not going to read this slide for you, but pause and take a look. If you like this video, you can watch other videos on my website on the free stuff page, both educational, trade of the week videos, and also videos of prior webinars that I have done. Tradability of stocks. What is the issue that we want to talk about in this video? Before watching this video, or right after watching this video, watch Controlling Slippage. These two videos should be watched together. The issue is trying to enter a position without missing the play, but also without paying additional fee known as slippage. The Controlling Slippage video reviews 6 things that will eliminate or help you reduce slippage. One of those items mentioned in that video was called Tradability of Stocks, and that is what this video explains. The more tradable a stock is, the more likely you will get the share size you want right at the bid or the offer. To determine this, you need to look at the level 2 screen. There are many different versions and yours may look different, but you want to see the different participants bidding and offering at various levels above and below the inside bid and offer. There are 4 issues you want to look at and a 5th item you want to observe. Number 1, the average daily volume of the stock. Number 2, the spread. Number 3, the depth. Number 4, the thickness. Number 5, how all of the above act when the stock moves, not just when sitting still. Let's take a look at each one of these. Number 1, the average daily volume. This is discussed in the other video about controlling slippage. This is your total answer and can be all you need to know. If you trade stocks that are very liquid, stocks that have big average volume, none of these other issues even arise for you. Right now, there are about 100 stocks that trade over 8 million shares a day on average. That's very good volume. And there's about 250 stocks that trade at least 4 million shares a day. That's very good volume for most people unless you're buying really large share size. You can buy thousands of shares of most of these stocks in a second with no slippage. High volume is all you really need, but if you must have the play on a stock that doesn't have the volume that you need, then you must look closer. The next thing you want to look at is the spread. Look at the 3 examples here. In number 1, the spread is 4 cents. That's the difference between the inside bid and the inside offer. That's 123.66 minus 123.70. There's 4 cents difference. In the second example, the inside bid is 149.58 and the inside offer is 149.61. This is a difference of 3 cents. That's the spread on that stock. And the last one, you can tell, looks more liquid. It is 73.70 by 73.71, a difference of 1 cent. That is as small as it can get. A 1 cent spread is the minimum there can be. Otherwise, the bid and the offer would match and there would be a sale and it would be removed from the screen. The second thing to look at is the depth. The depth is the difference between the various bid and offer levels. Here we're looking at the offer, and in the yellow, the inside offer is 123.70, but when those disappear, the offer will go to 123.79. So that is a 9 cent difference in the depth on that side of the screen. Over here we have 149.61 going to 149.62, so there's only 1 penny. And here we have 73.71 going to 73.72. Again, only 1 penny of depth. That's very liquid. Number 4, the thickness. This is the size at each of the various bid and offer levels. Here we're looking at the volume of the shares that are available on the inside bid or the inside offer. Example number 1, the offer thickness is 571. That's 471 plus 100 in the yellow. In the second example, there's 100, 100, 100. It's a total of 300 thickness on the inside offer of example number 2. And at number 3, you'd have to add all these up. It comes up to 5680 that's available on the inside offer. What that means very simply is that if you were to try and buy this first stock at the offer, if you were to go for 571 shares or less and you lifted the offer, you would get all of those shares immediately, provided you were the first one there. Naturally, if somebody beats you there, then they would take those shares. If you were to try to buy 1,000 shares, you would get filled on 571, but 429 would not be filled unless somebody else stepped up to sell those to you, and you would become the high bid for the remaining shares over on the left side of the screen. Likewise, for all of these, going way on the right, there's 5680 available. That means if you lifted the offer for 5,000 shares of this stock, you would be filled instantly if you were the first one there. If you wanted 6,000, you would get filled for 5680, and the remaining shares would go to high bid unless somebody stepped in to fill the rest of your order, but that would be optional. Most importantly is looking at how each of these interact when price moves. This is perhaps the most important. Liquid stocks are liquid. There are many players and they cannot fake it. But many of the bids and offers you see outside of the inside levels are fake. They are there to deceive. And there are orders that you don't see. Reserve orders, invisible orders, dark pools. But the truth comes out when prices move. Watch your stock trade and notice the bids and offers compared to the time in sales. The issue we're trying to solve in this video was trying to enter a position without missing the play, but also without playing an additional fee known as slippage. Number one, if you trade liquid stocks, none of this matters. When you have to have the play, a market order will get you in, but you will pay slippage if there is any. Number three, a limit order will control or eliminate slippage, but it is possible to miss all or part of the order. How much room to give a limit order is what all the analysis on this video is all about. It is an art and develops with experience. The tools I gave you here are the closest thing to a formula, but there's not an exact formula. The Controlling Slippage video reviews 6 things that will eliminate or help you reduce slippage, like the types of plays that you do. I want to emphasize again, even though it's in the other video, that a lot of slippage has to do with the types of strategies that you use to enter plays. Very simply, if you're buying a high of the day breakout on a stock that the entire world is watching and it is not an extremely liquid stock, you're going to have trouble getting filled. And also when the stock begins to move, it probably won't come back. If you're buying pullbacks of many sorts or using advanced type entries or legging in partial shares, you'll have a much better chance of getting filled. And finally, number 6, what I have found to be a very important one, let your order sit there until it gets filled. Depending upon your strategy, this may help not much, or it may fill you 95% of the time. For some reason, what baffles me is people will sometimes put in their order, and in the initial surge, if they don't get all of their shares, they just pull their order away for some reason. I never understood why. Let it sit there until you get filled. If you liked your trade, if you loved it, it was the best thing in the world at 10:02 a.m., it's very difficult to believe that at 10:02 and 12 seconds you hate the trade and you don't want it anymore. Let your order sit there, and for many, many trades, depending upon the entry you're using, it will come back to fill you. If you still have questions and you're not a part of the DTS seminar program, feel free to attend the next Introduction to Mastering Technical Analysis course. While this is the first part of the paid seminar, it's open to all members. It's held Friday afternoons before the first class. You can check the DTS calendar on the website for dates. This topic is discussed there, the topic of slippage and order execution, and you will have the ability to ask questions. You can also email me, paul@disciplinedtradingstrategy.com, and I'll be happy to reply to you if you have any other questions. This has been Paul Lange with Disciplined Trading Strategies with a video on the tradability of stocks and understanding order entry. I hope this has been helpful to you.